Micron just did something almost no company its size ever does. Over the past 12 months, the stock has gone up roughly 10 times. And the business behind it just posted the best numbers in its history, record revenue and record profit, as the world scrambles for the memory chips that power artificial intelligence. Wall Street is all in. 35 analysts rate Micron a buy, and some price targets run as high as $2,000 a share. But there's a problem with judging a company like Micron, because to know if a stock is truly great, you need a rival to measure it against. For Coca-Cola, there is Pepsi. For Visa, there is MasterCard. But for Micron, inside America, there simply isn't one, because almost no American company does what Micron does. So we went looking, and we found its real competitor 8,000 miles away in South Korea, a company called SK Hynix. It makes the same chips, it sells to the same customers, and it fights the same war for AI memory. And this matters to American investors right now because SK Hynix is about to launch one of the largest US stock listings ever, which means you will soon be able to buy it here at home. So in this video, we run both companies through the exact same model side by side to answer one question. Once you strip away the hype, is Micron actually as good as the market says it is? Here is how this works. First, we measure quality, which tells us how strong each business really is. Then we measure value, which tells us whether the price is actually justified. We will start with Micron. We score quality on three things: cash flow health, growth health, and profitability health, and every metric is scored against the semiconductors industry. Let's start with cash flow health, and here Micron is a fortress. It turns 57 cents of every sales dollar into operating cash. Its interest coverage is 257 times, and it carries so little debt that its interest payments are effectively a rounding error. Next is growth health, and almost everything is exploding. Revenue grew 167%, while gross profit, operating income, and free cash flow all surged. There was only one weak spot: earnings per share over the last 3 years, and that single number is going to matter a lot later in this video. And in profitability health, Micron is elite. Its EBITDA margin is 76%, its return on equity is 67%, and its return on invested capital is 57%, which earns nearly perfect scores across the board. Now the challenger company SK Hynix, we ran it through the same three tests. In cash flow health, SK Hynix is just as strong. It converts 54 cents of every sales dollar into operating cash. Its free cash flow margin earns an almost perfect score, and with interest coverage of 93 times, it too carries very little debt. In growth health, SK Hynix is firing on every cylinder. Revenue climbed 85%, and its earnings per share over the last 3 years grew by more than 3,000%, a number we will explain shortly because it is hiding something important. And in profitability health, SK Hynix is also world-class. Its EBITDA margin is 69%, and its return on equity is 61%, which puts it right alongside Micron, just a step behind on raw margins. So which company wins on quality? The honest answer is that it is essentially a tie. Micron scores 8.7 out of 10, and SK Hynix scores 8.9. These are two of the strongest businesses on the entire planet. Micron earns the higher raw margins while SK Hynix edges slightly ahead on the overall score. In other words, quality alone cannot separate them. So to break the tie, we have to look at price. Micron trades at around $1,132 a share, which makes it a company worth about $1.37 trillion. SK Hynix, once you convert it into US dollars, is worth about $1.24 trillion. So Micron is the larger of the two, but both are giants in the same weight class. Now look at how the market prices them. Micron trades at 18 times EBITDA, while SK Hynix trades at 20. On earnings, Micron sits at 25 times, and SK Hynix at 27. Both of them trade well above their industry medians, which means that by any normal standard, both stocks are expensive. This is where the model goes to work. It takes those elite quality scores and converts them into a quality premium, which is simply how much extra these businesses deserve to trade above the industry. Both companies earn a premium of around 45%, so they have clearly earned the right to be expensive. The only question left is whether they have now become too expensive. Let's start with Micron. The model puts its fair value at around $994, while the stock trades at $1132. That is only a 12% gap, so the verdict for Micron is fairly valued. Now look at SK Hynix. Its fair value comes out to about $1,122, but the stock trades at $1741. That is a 36% gap, so the verdict for SK Hynix is overvalued. So on price, Micron is clearly the better value. And not because it is the better business, since that part is a tie, but because the market has pushed SK Hynix much further from reality. But the model has a second lens, the growth lens based on Peter Lynch's method. And here it tells two completely different stories depending on one single input. Watch what happens. If we feed the model 3-year earnings growth, Micron reads as basically flat, so the growth lens skips it entirely. SK Hynix, on the other hand, reads 165%, which makes the model call it undervalued by 37%. So, in that case, SK Hynix wins. Now, if we change just one input and use 5-year growth instead, the entire picture flips. Micron now reads 26%, and SK Hynix reads 54%. With those numbers, the model calls Micron undervalued by 49%. So this time, Micron wins. Same two companies, same day, opposite answers. So which one is actually right? The reason comes down to one word: cycles. Memory chips boom, and then they bust. So a growth rate depends entirely on where you start counting. 3 years ago, Micron was climbing out of the 2023 downturn, so measured from that low point, its 3-year growth looks flat. 5 years ago was a normal year, so measured from there, that same climb looks like 26%. For SK Hynix, the 3-year window happens to capture the full snapback off the crash, which is why its earnings appear to grow by thousands of percent. But that is not durable growth. It is simply a rebound. And that is the trap. For boom and bust businesses like memory, the growth lens is unreliable because it bends depending on the window you choose. The value lens does not bend, and it gave the same answer both times. Micron is fairly valued, and SK Hynix is overvalued. So that is the number we should trust. So here's the twist. The one rival closest to Micron trades even richer, which makes Micron's fair price the verdict worth having. If this breakdown helped you see Micron in a different way, then hit subscribe and tap the bell. That way, the next verdict lands the moment it drops. This is the valuation verdict.